Co-ownership buildings are a unique and often misunderstood form of property ownership in Toronto. They're similar to condos in terms of lifestyle, but they have a different ownership structure. You'll mostly find co-ownership buildings in older pockets of the city, especially midtown Toronto, places like Yonge and St. Clair, or around Forest Hill and South Rosedale. These buildings typically date back to the 1950s or 60s and look like rental apartment buildings, but they're actually owned by individual shareholders. Here's how the ownership structure works. Instead of owning a specific unit like you would in a condo, you own a percentage of the entire building and common elements, and then you will receive exclusive use to your unit, your parking spot, and your locker. So technically, you don't own the unit itself, you own shares that are tied to that unit. And your name does go on title, but it's on title along with all of the other owners in that building. One thing that surprises people is that you don't need board approval to sell or rent your unit. You're free to list it on the open market or lease it out just like you would with a condo. That said, any major renovations will require board approval, but that's no different than traditional condominiums, which also have rules around what you can and can't do in your unit. Now let's talk financing, and this is where things get tricky. Because you're buying shares and not a deeded unit, co-ownerships don't qualify for traditional mortgage financing. Not every lender will finance co-ownerships. In fact, most big banks won't touch them. But there are a few lenders in Ontario that will, such as Parama Credit Union, Duca Financial, and Luminous Financial. These loans often come with slightly higher interest rates, and the down payment requirements are usually larger, often 20 to 40%, depending on the lender and your credit profile. So what are the pros and cons? Let's start with the benefits. Pro number one, co-ownerships are typically priced lower than condos in the same neighborhood, making them an appealing option for buyers who want to live in a great location but can't afford typical condo prices. Pro number two, maintenance fees often include your property taxes, which can simplify your monthly budget as you won't have to pay a separate tax bill from the city. Pro number three, the buildings are often well maintained with a more community-oriented feel compared to larger condo towers. And pro number four, as co-ownership buildings are typically older, you are getting a unit with larger square footage than the average Toronto condo. But there are also drawbacks. The first is that resale can be harder. Because financing is more limited, your buyer pool is smaller. Another drawback is that it will appreciate at a lower rate over time, so it wouldn't necessarily be the best investment option if you're looking for a return on your funds. And the last drawback I'll mention is that most of these buildings lack curb appeal and tend to be more modest in appearance, especially in the lobbies and hallways. Most also offer few, if any, amenities. If you're considering a co-ownership, make sure your agent and lawyer understand the structure well. It's not your typical real estate transaction, and you'll want the right team in your corner to help you understand the risks and responsibilities. If you're curious about co-ownerships and whether they might be a right fit for you, feel free to reach out. I'd be happy to walk you through it.